You're with us here on a fresh new edition of Bazaar Morning Call. Good morning, I'm Prashant. With me, my colleagues Sonia and Reema. Guys, hi.
Hi.
I have to warn the viewers that we're not trying to tell you anything in terms of what the market should do with the colors that...
We're dressed for Christmas and we're not dressed to tell you what the market mood is, though it is very bearish.
It is a bit red, right?
I can't help but feel festive. I mean, it's Christmas Eve tomorrow. The bulls and the bears are on leave, guys. So, no one's really feeling this market anymore. I think all the feelings are going to come out from the 1st of January.
We have to believe that people are watching, Sonia. Carry on. Okay, let's just quickly tell you the action in terms of how things are set up. So what do we have, right? I mean, and I want to start with just an extension of what I put out right at the word go yesterday morning, which is Nifty moves. The volatility continues. And this is the 6th session where we've seen, for 6 days now, we've basically had an average of 200-point intraday moves, and yesterday was no different. So, you can see yesterday, day before yesterday, big sell-off from the day highs. The 2 days prior to that, a big pullback, 200-point pullbacks from the day's low. So this is extremely volatile. I could further dissect this with all the moves intraday that we saw, and that amounted to some 600 points, 650 points on the Nifty. But I'll spare you the details. In any case, I think we can agree that it's been extremely tough to kind of trade the market, especially if you're trading very near term. It's been completely very, very difficult. Overnight cues. So Wednesday, we saw out of the US a decent rally, but that was completely wiped off. So this is the change last night, S&P 500. By the way, this is good news because, I mean, S&P was down 3% at one point. NASDAQ was down 4%. So losses were cut in half by the time the US market session ended. US indices on your screen, jobless claims and GDP numbers both beat expectations. Now, this is the kind of confusing market we are in. We had, remember, on the previous day, on Wednesday session US, we had the consumer confidence numbers, right, which came in stronger than expected. And the market decided to cheer that. Yesterday, you have more stronger data, 2 more numbers, and the market decided to sulk. I think it's just basically uncertainty about how much more there is to go in this current cycle. I mean, it's in a bit of a state of flux. So yesterday's data, in a way, validating Fed's view that US economy is strong enough to take more punches, take more tightening, withstand more tightening. And I think that was the wisdom which prevailed yesterday. Tesla, by the way, is one name which sold off 10%. We'll talk more about that. I call it it's not just Tesla, it's talismanic Tesla. It's got properties, it's got other properties which normal stocks don't have. And we can talk more about that. I mean, it draws retail investors in a cultish-like behavior, which no other name does. No other tech name, not Apple, nothing else does. Tesla was down 10. As I said, we'll talk more about that. On the Nifty here, we put this number out yesterday morning. The number exactly is not 18,100. It's about 18,080 or so. But let's round it off. 18,100 is a support. The market yesterday bounced exactly off those levels. And I'll put a graph out which tells you that. But on the Bank Nifty, yesterday's low, which is 42,231, is the first support, really, which one needs to watch out for. I think one thing is very, very clear. It's been absolutely futile to chase the move straight up. From extremes, the market has turned either on the way down or the way up. The Nifty graph will make that point even better. This is something which we put out yesterday in the afternoon closing bell as well. So that's a trend line drawn from the lows of June 17th. That was the absolute low on the Nifty. Then it's got a second touch point on the 30th of September. And yesterday, we got a bounce exactly off that level. Actually, to be very, very technical, we saw a break of that for a few, I think, half an hour or so. And then the market bounced off that particular level. And that is about 18,100. A little lower than that, but let's say 18,100 roughly is what the market needs to hold. The SGX will come up on your screen. And I think SGX at least is indicating we will start around that 18,100 level, maybe slightly below that, around yesterday's low, 18,090. That's about 90 points lower. Sonia, hi. Reema, hi.
Hi, morning. So it's an ugly start, right? As someone on Wall Street was putting it, Santa Claus perhaps lost his way a little bit. And it is the law of averages as well. I mean, in 2020 and 2021, you had a Santa Claus rally in the US, and this time perhaps it's not playing out. But having said that, it's a sell-off that has resumed globally. So not just in the US markets, but even across Asia. Japan saw its core inflation hit the highest level in 40 years overnight. And the Nikkei market, as we speak, is down almost about 300 odd points. So keep that in mind. Brent crude is back below $81 a barrel. There are, of course, rate hike fears once again. So that's another data point. But in India, very interestingly, both foreign and domestic investors bought in the cash markets yesterday. And there was a large buy figure from domestic investors, over 2,200 crores. So let's see if that provides any kind of support to the market, over 900 crores of buying from FIs as well. Now, a couple of levels that I'm watching, in addition to what Prashant just spoke about, the 50-day moving average was breached on the downside yesterday, 18,166. So does that open doors for a further downside in the market? The Nifty, remember, is down 3.5% in December already. The Nifty IT index is down 6%, and we head into IT earnings as well. So keep an eye out on these pockets. And a lot of these gainers of the year, whether it's an Axis Bank, something like a Tata Motors, Ambuja Cements, all seen long unwinding yesterday. So I'll keep my eye out on that. There are two interesting pieces of news in the IPO market as well. There's the Landmark Cars listing that takes place today. It was subscribed over 3 times. So let's see how that shapes up. And there's also an IPO that opens today called Radiant Cash Management. It's an integrated cash logistics player, so I'll watch out for that as well. But all in all, looks like it's going to be a rather ugly start to trade.
Absolutely. The SGX Nifty right now is down 0.5%, lower by 80 points. That said, the sell-off that we're seeing on the SGX Nifty is not as bad as what we're seeing across the rest of the Asian markets, where the cuts are deeper, down 1 to 1.5%. The Korean markets, Kospi down 1.6%, Taiwanese markets down 1.3%, and you can see the Japanese markets down 1% as well. The question is, did the Indian markets preempt part of the sell-off at least yesterday? Because yesterday, the Indian markets closed in the red despite a positive bias in the global indices. And while the damage on the benchmark indices, the Nifty and the Sensex, was not very deep, the benchmark indices were down 0.3%, 0.4%, you did see a fair amount of selling in the broader markets. Look at the advanced decline ratio yesterday at 1:6. Nearly 2,500 stocks ended in the red. So there was a fair amount of meltdown that we saw in the broader market. Just to underscore the point that Prashant was making, yesterday's low of 18,070, 18070 will be very crucial because it coincides with the 38.2% retracement of the recent up move from 16,750 to the all-time high levels of 18,888. So these two indicators coincide. So 18,070 will be very crucial. Meanwhile, you spoke about buying seen by the DIIs in the cash market and the FIs. Look at the kind of buying that we saw in the Ajanta Pharma block, right? Yeah. So many of these marquee DIIs, MFs have bought, and maybe that partly explains the DII buying, because a lot of MFs, mutual funds, were buyers in the Ajanta Pharma block deal yesterday. By the way, in the futures and options space, the FIs have been steadily unwinding their long positions. On 1st of December, the FI longs on the index were closer to 76%. For the last 3 days, it's below 50%. And yesterday, it came down to 46, 47%. The short positions, consequently, have been going up. So broadly, the market mood continues to remain somber. The Indian markets have remained under pressure this month. Barring some intermittent rebounds, the Nifty has fallen close to about 4% from its all-time high levels that we hit on 1st of December of 18,888. That's the positioning.
Okay, well, we start off with an ugly day of trade, but guess what? It's the last day before most people go off for their Christmas and New Year holidays. So there's definitely a lot of festive cheer on the street. Let's see if that can translate into gains on the equity markets as well. First up, we have a comment coming in from Gautam Dugard of Motilal Oswal Financial Services, who says that markets will see higher volatility now due to recent COVID concerns and government's increased caution. He says there is no room for re-rating on valuations and market could see consolidation in a range. He says no major sell-off is expected either, because India is well supported with strong fundamentals, and he would look to buy tech stocks and financial names, Axis Bank, ICICI Bank, SBI, Infosys and TCS on a dip. And he's also looking to buy rural consumption stocks like HUL and M&M. He's expecting the rural economy to see a recovery in the next few months.
Okay, some money market views now. This is Bhaskar Panda of HDFC Bank, who says that resilience seen through recent US data has brought back fears of higher rates for longer as far as US goes. He says the dollar index gained and oil remained a little elevated, which means Asia, ex-Japan currencies will be under pressure today. Given this background, he expects the dollar INR pair to trade in a range of between 82.75 to 82.95 to a dollar for the day.
On the bonds, Bhaskar Panda says RBI MPC minutes show that members continue to be concerned about inflation. Hence, policy tightening is going to stay, and benchmark yields have moved up a bit because of that. He expects the 10-year benchmark bond yield to trade in a range of 7.3 to 7.35% for the day.